Hey traders, I hope you're having a great weekend. Today's analysis will be very comprehensive and will be published to the home page under the General Outlook section. My analysis will encompass all three time frames, the short term, intermediate term, and the long term. Of course, for traders, the short term is of utmost importance. That's exactly why I'd like to start with the short term to alleviate some of the concerns that were voiced on Friday. For example, in one tweet, a subscriber inquired whether a close above 1930 on the S&P 500 would invalidate the case for further downside. And in the email below, another subscriber relayed to me what he read on one of the blogs regarding a top 10 market timer who issued a buy signal at Friday's close. All of these are legitimate concerns, and I'm glad to see subscribers doing their own homework and research instead of just follow me blindly. On my end, voicing these concerns make me want to scrutinize my own work, forcing me to go back and try and poke holes in my own thesis. Now, I'm glad to report that after hours of analysis this morning, the thesis is still intact. Part of the goal today is to show you exactly why this is the case. Let's start things off with a 10-minute chart of the NASDAQ 100. As you may well know from Thursday night's video, I said that my expectations were for the NASDAQ 100 to bounce off the lower trend line of the falling wedge and make one final visit to the upper trend line before resuming lower. Well, that's almost exactly what happened, with one major caveat, and that is the index took out the upper trend line. It cut through it like a hot knife through butter. And that's when I got my eureka moment. I quickly recalled that a falling wedge has a 68% chance of breaking out in the upward direction. And that's regardless of the direction of the preceding trend, which of course was down. Now, this 68% stat is not my own. Let me show you. On his homepage, thepatternSite.com, Thomas Bukowski provides identification guidelines for the falling wedge, and he states under the falling wedge identification guidelines section that the breakout can be in any direction but is upward 68% of the time. And this alone gave the bulls a slightly better than a 2-to-1 edge over the bears on Friday, and that's despite the overnight events that took place overseas. This bullish breakout, which occurred upon the NASDAQ 100, taking out the upper trend line of the falling wedge, puts the target near the prior high. That's one of the guidelines, that the immediate target is the inception point of the wedge. Now, there's a confluence of three lines right here. That is the green line, the dashed line, which is perfectly parallel with the lower one. I took a parallel line to this one and I drew it across Monday's high. This line intersects the yellow line, and that yellow line is an extension of the lower left side of the diamond top, which proved to be resistance on two prior occasions. So it could play a role again on Monday or early next week. The third line is, of course, the 88.6% retracement of the entire decline that began from last Monday's high and lasted through Thursday's close. Now, you might be wondering how all of this disproves the notion that the pullback ended at last Thursday's low and that we're in the midst of a new bull run aiming to set new all-time highs somewhere down the road. My job, of course, is to show you why this is a low probability scenario, even though price is totally free to do whatever the heck it wants without asking me for permission. For this, let's wind back the clock to July 24th, the starting point of this ongoing pullback, or correction, if you will. It began with a simple ABC, which I labeled wave W. Notice how red wave B unfolded as a contracting triangle, A, B, C, D, E in black. And then wave W gave way to a brief relief bounce, which I labeled wave X. In turn, wave X gave way to the second installment of this correction, another ABC, which I labeled wave Y. From wave Y, another relief bounce got underway, a much deeper relief bounce that almost tested the prior high. However, as soon as price resumed lower and took out the endpoint of wave C of Y, I quickly declared that this double zigzag is going to degenerate into a triple ABC, X, ABC, X, and a final ABC that should bring the entire complex correction to an end. Now, according to the Elliott Wave theory, 3 back-to-back zigzags is as far as a correction should go. Now, this third and final zigzag certainly did get off to a good start. Notice how red wave A possesses all the attributes of a 5-wave impulse. Black wave 1, black wave 2, black wave 3, black wave 4, and black wave 5. Within black wave 3, I even showed the 5-wave subdivisions in yellow. The same with black wave 5, 5 subwaves in blue. This satisfied me enough to label this low on August 1st as the endpoint of red wave A. Upon the conclusion of red wave A, I said to expect a relief rally to be labeled red wave B, which should retrace 50 to 61.8% of red wave A. A 61.8% retracement would have coincided with the gray and yellow lines. You know what those are. But Monday's high retraced exactly 50% of red wave A. And then Tuesday's purposeful reversal led me to label Monday's high as what? Red wave B. I said then that red wave C must be underway. This red wave C should end the entire complex correction. In hindsight, I was wrong. Now I heavily favor the scenario in which everything to the right of wave A is part of an ongoing red wave B. In other words, red wave B, not only is it consuming price territory, but time territory as well. Red wave B is unfolding as a sideways pattern, a complex pattern within an already complex correction. Now, there's one more thing for me to do to prove to you that red wave B is ongoing. Okay? In fact, there are two things. The first thing that I must do is draw your attention to the fact that red wave A subdivided into a 5-wave impulse as expected. Had red wave B ended at last Monday's high, then everything that ensued should have also subdivided into a 5-wave impulse, allowing us to label last Thursday's low as red wave C. Under no circumstance can anyone count this entire structure starting at last Monday's high and ending at last Thursday's low as a 5-wave impulse. It's impossible. It's not a 5-wave impulse. And I'm going to count them one subdivision at a time as soon as I drop down to an even lower time frame than the current one, which is 10 minutes. I'm going to drop down to the 1 or 2 minute time frame and count every subdivision for you, starting at the low of red wave A and ending at Friday's high. And I'm going to show you how we're going to get as high as 39.10 or 39.13 as early as next Monday. But before I start the wave count process, take a quick look at what the chart would look like should the index continue to rise towards the highest peak of the falling wedge as anticipated and as the guidelines suggest it will. A complex head and shoulder stop. Two left shoulders, LS1, LS2. Two heads, H1 and H2. H1 is a diamond top. H2 is a head and shoulders of its own. And two right shoulders to go with the two left ones. Now, whenever the right shoulders are lower in general compared to the left shoulders, it portends weakness in the market. Now on to the wave count. Of course, I performed the wave analysis ahead of time. Otherwise, I would have bored you to death or caused you to fall into a coma. The bounce into last Monday's high unfolded as a typical ABC zigzag where waves A and C are equal. Within wave A, I identified the 5 wave subdivisions, black waves 1 through 5. The same with wave C. I identified waves 1 through 5 in black. Within black wave 3, I identified 5 blue subwaves. And within blue waves 3 and 5, I went the extra step to identify the 5 yellow wave subdivisions. And finally, within black wave 5, the 5 wave subdivisions in blue. Next, what unfolded from last Monday's high to last Thursday's low is a counter-trend pattern that is as complex as this entire corrective phase that began back on July 24th. This counter-trend move into last Thursday's low fooled most people, including me, into believing that wave C of the third and final zigzag is probably underway. Why? Because it printed 2 new lows relative to the endpoint of wave A of this third and final zigzag. Now recall that at the conclusion of wave A of this third and final zigzag that is expected to bring this entire corrective phase to an end, the market, according to many metrics, was already pretty oversold. So on August 1st, the market was pretty oversold, and the bounce into last Monday's high aimed to relieve part or all of this oversold condition. And then the very next Tuesday, the market resumed lower, giving us the impression that wave C of the third and final zigzag was probably underway. In hindsight, that was inaccurate, even though 2 new lows were recorded on August 6th and 7th. Why? Because the entire move down from last Monday's high and into last Thursday's low does not exhibit the typical characteristics of either a 5-wave impulse or even an ending diagonal. That's unlike wave A, which was demonstrated to be a picture-perfect 5-wave impulse. Now, one might ask if last Thursday's low wasn't the end of wave C of the third and final zigzag. Then how come 2 new lows were recorded relative to the August 1st low, the starting point? And recall that we initially placed wave B at last Monday's high, wave B at the 50% retracement of wave A. And then last week's developments forced us to reconsider our choice. We're now of the view that wave B is ongoing. It's unfolding as a sideways pattern expected to end sometime early next week up in this area right here. And so how does one explain these 2 new lows that were set last week relative to the August 1st low? Start by asking yourself, what's the purpose of a relief rally? It is, of course, to relieve the market of any existing oversold condition by reclaiming some of the lost points. And that's what the move into last Monday's high initially appeared to have achieved, because the very next day the market certainly moved lower. And on August 6th, it managed to take out the August 1st low. But the move proved to be unsustainable because it failed to move materially lower. Why? Because the market was still oversold. The move into last Monday's high was nearly not enough to completely erase the oversold condition. And so from the August 6th low, the market bounced back partially, only to attempt once again and fail to move materially lower. So, in conclusion, we now know and understand that the move down from last Monday's high into last Thursday's low is all part of a very complex consolidation phase. What we've got on hand here is a consolidation phase that is as complex as one could get. Now, from an Elliott Wave perspective, this Monday through Thursday phase is best interpreted as a triple zigzag. The initial ABC down in black, followed by a counter-trend zigzag, purple wave X, and then another black ABC, that's the second zigzag, Notice how within wave A, I went the extra step to identify blue waves 1 through 5. And within blue wave 1, I did the same thing in yellow. Yellow waves 1 through 5. I did this same thing whenever possible. Anyway, from the bottom of the second zigzag, another relief rally unfolded, setting the stage for the final zigzag down to complete a triple zigzag in wave X. Remember that 3 back-to-back zigzags is as far as a corrective pattern could possibly go under Elliott Wave rules and guidelines. In light of what's transpired so far, meaning the initial ABC up into last Monday's high, the subsequent triple zigzag into last Thursday's low, what's left to complete the overall pattern is another upward ABC. Therefore, the initial move up from last Thursday's low is labeled wave A. The counter trend pullback, wave B. And then wave C got underway, starting with black wave 1, followed by a shallow wave 2. And on Friday afternoon, black wave 3 was approaching its end. I'm expecting wave 3 to end in the vicinity of these two prior peaks right here. And by then it will roughly equate to 1.618 to 1.764, the size of wave 1, typical for a third wave. The fourth wave will clearly pull back to the area of the prior pivot low right here before setting the stage for wave 5. Now, based on these projections, I calculated the size of wave 5 and found out its ideal target zone to be in the vicinity of what? The 88.6% retracement of the falling wedge, the green line, and the orange line. That would be the 61.8% right here, the most common projection in wave 5. Now, of course, we don't know for sure whether wave 3 will end here and wave 4 will end here. But based on these estimates, the overall picture looks very, very good. Now, something very similar happened last Monday. The market gapped up to complete wave 5 and therefore wave A shortly after the open. And then it started pulling back in wave B to the area of the prior fourth wave. And then it rallied through the end of the day to complete a 5-wave move in wave C. Now, this Monday, what I expect is for wave 3 to complete shortly after the open, setting the stage for a pullback in wave 4 to the area of this prior swing low. And then from wave 4, I expect wave 5 to get underway. Okay? Alrighty. Let's see what happens next Monday. And good luck.